In this video, we're going to talk about more details within the firm, about making decisions, right? So let's just jump right into it. So what does the finance function do? And we've talked about this, right? We know that financial managers make key decisions. They talk about investment decision. That is, are there things that we can buy from an investment perspective? Now, this isn't talking about operating assets. This is talking about other companies or the securities of other companies in general, just like you and I might think about investing. Capital budgeting decisions are the decisions about operations, right? That's buying plant and equipment. And financing decisions, right? This could be long-term, short-term. The capital budgeting, capital structure decisions, talk about how do we raise those long-term dollars to expand the company. And working capital decisions are all about managing the cash flows of the company. Now, how does this work within the company? And again, I think this is something that is sometimes misunderstood, right? Investment decisions are on the left-hand side of the balance sheet. Investment decisions have to do with buying or investing in fixed assets, such as plant and equipment, and some long-term investments, if you will, and also the purchase of current assets. Financial decisions, though, the financing question is answered on the right side of the balance sheet. So this talks about, in general, where do we get the money in order to pay for these things over here? So I kind of like to think of this balance sheet in this way, right? This is our investment, and this is the dollars to invest. And we're going to talk about this in several chapters or several videos, later on in this series, where how do managers decide how to get money to buy assets on the other side? In addition, in videos, we'll talk about how do we decide what to buy. So those are some very important questions that management has to ask. So what are their general principles? What are the things that they think about when they're trying to make these decisions? The first thing, time value of money. We're going to have a series of videos that talk about how do we find the value of dollars when those dollars might not happen for many years. We're going to talk about the trade-off between risk and return. We've already mentioned in a couple of videos that cash is king, right? Cash is what drives the world, so we need to be in control of that. And of course, from a more economic perspective, competitive financial markets are very important. Do we actually have competitive financial markets? And if not, how can we deal with that issue? And certainly incentives are very important, right? Not only the incentives to the business, but the incentives to management is also probably going to drive many of the decisions that management makes. So let's think about the organization of the company. Everybody understands that the CEO, the chief executive officer at the top, but the CFO, they are in charge of the finance function. The treasurer, the controller, they have to do with the internal auditing, foreign exchange. So if we look at a graph, we see that under the CEO is the CFO. Again, there are other chief executives, right? There's a technology officer, operating officer, right? They have different functions. But under the CFO, here are the basics of understanding the finance function and what they do, right? The controller, basically that's the head accountant of the company. The treasurer, that's the person that's in charge of managing the cash, understanding and being the director of risk management. So again, that is the process. Those are the positions, if you will, of the financial function in the corporation. So how does finance relate to economics? And finance is a offshoot, if you will, or it comes from economics. From my perspective, I think of economics as being a more theoretical explanation of the world. Lots of research done basically to explain how the world should work. Finance, to me, is more of a practical application of those theories and ideas. So, from my perspective, I think finance is a practical, hands-on type of a discipline. The primary aspect of economics that relates to finance has to do with the marginal cost benefit analysis. How do we choose between two things? Well, you're going to compare the benefits that you get to the costs that it's going to take to receive those things. But another thing I think that is missing here is how supply and demand affect the company. If you think about a company's stock has a supply, and the supply of a company's stock to investors comes from the company. So if the company wants to increase the supply of shares for you and I to buy, they issue shares and the supply curve moves or shifts to the right. And vice versa, if they repurchase it, it shifts the other way. But the demand curve is driven and is created by you and I, investors. We get information and we analyze it and determine whether or not it's good or bad. And as a whole, if we all think it's good, we all want to buy, that increases the demand curve or shifts the demand curve outward, and the stock price will go up. So when we're thinking about when managers are thinking about decisions and they're concerned about what's going to happen to the stock price, they're really thinking about how is this choice going to affect the analysis of investors? Because however we decide to analyze that information, that's the direction that the stock price should move. One of these very short kind of examples of marginal benefits, right? We have a company that the total benefits of a new widget maker is $1 million, and the old one would have produced $600,000 in today's dollars. So the marginal benefit is whatever it would have produced today minus what it would have produced before. So the marginal benefits should be $400,000. What are the costs? Well, the new widget maker is going to cost $300,000 to install, while the old kettle can be sold for $100,000. So the marginal cost, it's going to cost us $300,000, but we're going to receive $100,000. So the marginal cost is $200,000. So what are the net benefits? $400,000 is the benefit minus the $200,000 is the cost. So this should have a total net benefit to the company of $200,000. So we should do this project because the benefits exceed the costs. What does finance have to do with accounting? Well, they are very closely related. But let's think about what accounting is all about. Accounting primarily is the process of identifying economic transactions and converting those transactions into financial statements. Now, that's done under a variety of accounting methodologies. We have something called the accrual basis that basically recognizes revenue at the time of sale and expenses when they're incurred, regardless of when cash exchanges. Cash basis only recognizes those events when cash actually trades. So most businesses are going to deal with the accrual basis of accounting because they recognize things when they occur. What this does is causes a difference between the accrual basis, which is the standard accounting, and cash basis. So we want to understand, if you remember, we're only interested in measuring and thinking about cash rather than profits. So here we have a dealer that have $1 million in the calendar year. They originally purchased a yacht for $800,000, and they paid in full for the yacht during the year. At the year's end, it hasn't yet collected the $1 million from the customer. So it sold it for $1 million, bought it for $800,000, but hasn't received the $1 million. So what I hopefully we're going to show here is the difference between profit and cash. In this instance, the accounting view, and for taxes, we're going to show a net profit of $200,000. However, we have received no cash, which means our net cash flow is a negative $800,000. So if we have to pay this tax bill, where's the money going to come from? We don't have any money, right? No money has come in the door yet. So the difference between profit and cash is very important, right? We only want to recognize and utilize variables when we can identify and actually use the cash. So cash flow is critical. And again, if you think about this relationship with accounting, accountants devote most of their time to creating financial data, creating financial statements. Financial managers take those statements, add some more analysis and data, and then they make decisions based on their assessment of the associated returns and the risks associated with that data. So again, how accounting, economics, how it all works together in the company is a fairly complex circumstance. So again, thanks for watching the video. I look forward to seeing you soon.